Welcome everybody to this month's market update. We've had a lot of exciting information. We're going to see how much of that we can cover here in the next couple of minutes. Wanted to welcome you out, Gage with Oxford Wealth. Let's dig into it, shall we? So first off, there's our disclosures. Got to leave those on the page just so that we can see who we are and what we're doing and what we don't do and all that good stuff. So market update. July. It's been kind of an interesting month. There's a lot of bad out there, but a lot of good is coming of it, which is kind of interesting. So we're going to talk about what's going on in the markets and kind of the economy in general. And where do we go from here? We're halfway through the year. What's our halftime report look like, and what should we be focusing on for the remainder of the year here? So let's talk about what we've seen. Mr. J. Powell there, he's got his studious glasses on to help us kind of discuss what we're paying attention to. So number one, we have recessionary concerns. We had 2 consecutive quarters of negative GDP growth, they call it, 0.16 on one day and 0.9 on the first quarter and 0.9 on the second quarter. So technically we're looking at recessionary curves, recessionary concerns. So one interesting fact about this is the first quote unquote recession that we've had since 1947, where we've had such a strong labor market. So it's going to be interesting to see kind of how this all plays out. A big indicator that we're looking at right now, the yield curve has been inverted since the beginning of July, hasn't really improved over all that time. We'll look at that here in just a second. I think all of us are aware of inflation, the concerns that we're seeing there. And some of what the Federal Reserve Board is doing to combat that. They've increased rates again for the month of July, another 0.75, another historic move. Previous to the last 2 increases of 0.75, we hadn't seen that since 1994. So huge jumps in interest rates recently. We're starting to see the real estate market cooling off. So I think as a direct result of some of these rate increases, we're seeing certain industries start to slow down a little bit. I don't know about you, but we've heard a lot of folks that are selling houses. Houses are on the market for a week to 10 days longer than the last year's average. Also, I'm not hearing very much about people that are getting over asking for their house anymore. People where we got bidding wars and things like that. So we're starting to see that real estate market cool down, which is good. And we were in a period of, well, to use Alan Greenspan's term, irrational exuberance, especially when it came to the real estate market. Like I mentioned, the labor market's still red hot. We still haven't seen any recessionary trends. We'll see in the next couple of weeks and months whether that starts to slow down and follow recessionary concerns. But as of right now, I mean, everyone's still hiring. We still have a massive amount of job openings. That's a very good positive sign that if we are in a recession, we'll recover it hopefully relatively quickly. And then just for your quick snapshot information, one of the strongest pieces of information that we have for the month of July, we're just about to wrap up trading here in a couple of hours for the month. S&P 500 as of yesterday was up 8.7% on the month. Dow is up 6.1%. And look at this, the NASDAQ, 12.3%. They had a double-digit month, which is pretty darn exciting. Haven't had those very often, so the month of July is looking pretty strong. I'm sure a lot of us are excited when we open up the brokerage statements and see some of those returns. So that's kind of where we stand. That's what we're looking at. Let's dive into some of the specifics. So GDP, just so that we're aware of the numbers, Q2 was down 0.9. That was lower than expected. The Bureau of Labor had determined that I think they were sitting on a 0.5% increase. So I don't know if they were doing that just to make sure that we're all happy and excited. They're never going to forecast a recession. But I mean, here we are. We're seeing negative GDP growth. We all know Q1 we were down 1.6. So far combined for the year, we're down a little over 2. That's a little nerve-wracking. That's something to definitely pay attention to. We haven't seen this since the whole COVID crisis in 2020, and before that, 2 consecutive quarters of GDP loss started in Q3 of 2007. So kind of an interesting discussion that we're looking at here. Consumer spending, something called PCE, was only up 1%. They were expecting it to be 1.2. That's usually normally pretty low. Americans kind of in general don't spend as much through the summers. So it'll be interesting to see how that bounces back for quarter 3 and quarter 4. We're hearing a lot of that retail discussion. So I don't know if you saw like Walmart and a lot of big box retail stores, Target. They're adjusting their earnings because things aren't looking as positive for them. There's a lot more cost and expense that I don't think they were forecasting for this year. So this is going to be an interesting factor to look at. We'll pay attention to the PCE moving forward. CPI for July was reported middle part of the month. We're up 9.1%. Kind of shocking because the previous month we were up 8.6. So even though the Federal Reserve was putting all these rate hikes in place, we still saw an increase in consumer price index. And that PCE number for July was looking at 6.3. So there's some factors that we're looking at here. We gotta pay attention to them. And then the biggest one here is that the yield curve inverted. At least this is the biggest piece for us. Yield curve inverted July 6th and has remained inverted. Some of you have seen this chart. We talk about it a lot. This is from the Federal Reserve's economic data website. You can go and pull this yourself if you'd like. The 10-year Treasury minus the 2-year Treasury. So we're looking specifically at what those two treasuries do in relation to each other. This is never a good sign. This is always worrisome. We saw yield curves invert. We're saying almost that they just hit zero. They did invert ever so slightly, but it was so close that everyone's calling it kind of a one-off event. Same kind of thing in 2019, we saw the yield curve do kind of the same thing, but this sustained down by a pretty wide margin hasn't really happened consistently since 2006. And we haven't seen a yield curve inversion this aggressive since 2000. So it's been almost over 20 years since we've seen this kind of volatility. This is going to be the indicator that we pay attention to the most. I think this is one of those leading indicators that a lot of people will focus on. I don't think we're out of the woods yet when it comes to economic recession and market turmoil. And this chart just backs up that discussion. So we got to pay attention to that. Now, to combat that, the Federal Reserve is playing this game on interest rates. And what's really interesting is the Federal Reserve increased interest rates on Wednesday, another 0.75. So we're sitting right now between 2.25 and 2.5. Their goal by the end of 2023 is to be sitting somewhere between 3.5 and 3.75. For those of you astute students of Oxford Wealth, you may remember when Lynn was talking about that, that was a 1/4 point less. When he reported, it was a 1/4 point less than what they're reporting now. So the markets have already factored in another 1/4 point rate increase sometime before the end of the year, higher than what they were already expecting. We still have some room to grow here. Still have some room to grow. So from the 2.5 up to the 3.5% target, we are expecting another 1% increase to happen sometime between now and December. What's really interesting about this is Jerome Powell has now said that they're not going to be as transparent. They're not going to let everyone know ahead of time kind of what they're doing. He doesn't like how the markets are responding to the news that he's releasing. So they're going to keep it a little bit closer to the vest and not share until they make the change. That'll be interesting to see how that works. That also tells me that they're not going to do anything too drastic. So we're not going to see any more 0.75% increases. I'm guessing from here on out through the rest of the year, we'll see either 0.5 point or 1/4 point increases. And that's consistent. If he does 1/4 point increases, he only needs to do it 4 times in the next 6 months. So the Federal Reserve definitely has some room to pay attention to that. That would suggest then that inflation is starting to calm down a little bit. So we want to talk about something here real quick. There have been a couple of numbers that are being thrown out there, and we've heard some confusion about this. So CPI is the magic word that we use for inflation. And then we have this thing called core CPI. This is sometimes referred to as household inflation. So consumer price index, the number that we use for inflationary concerns will usually include things like fuel, like food, but because those are so volatile, a lot of the times when they're reporting on inflation numbers, they'll pull those out. Now, just realize some of you may already know that. You may know that they kind of skew what the inflation numbers look like, but it is reported if you're looking at both. Consumer price index should be the total deal. Core CPI is usually going to pull out things like fuel and like food. There are some good indicators on inflation right now. So things like housing, used and new cars, even oil and gas to some extent has seen price falling in the month of July. Housing is starting to slow down. I think mortgage interest rates are kind of forcing that. Used cars are not as bad as they were 6 and 12 months ago. They're still higher than they, in my opinion, should be, but we're starting to see that come down a little bit. Car lots are starting to have a little bit more inventory on hand. So I know this isn't true across the board, but looking at nationwide averages, things are starting to improve there. And then all of us have seen relief at the pump. I mean, in the last probably 30 days, the price of oil or the price of gas has dropped much more to a reasonable level. National averages are much lower. Now, this is good, and this is suggesting that some of the federal rate increases are starting to work on playing inflation. But there are some other concerns that we're paying attention to. We still think inflation is going to be there for the next year or two. It's still going to be a significant concern. We're not going to see the double digits, and we've probably peaked on how high we expect CPI to be, barring there's not some crazy one-off event that happens between now and, I don't know, whenever inflation starts to officially quell. One thing to keep in mind before we look at the next chart here is July's CPI numbers. That's going to be the big indicator. We're going to know whether we're off the roller coaster or whether we're still on it. This will be released by the middle of August. So by the 15th of August, we should know kind of what those CPI numbers look like. And expect in our next market update call that we'll probably be talking about this still. So here are some of the leading indicators. So this is the headline inflation. This is like what you and I buy on a regular basis. This is the inflation that includes things like food and energy. We can see that's sitting at 9.6. Whoops, wrong number I circled here. 9.1 is the number that's currently being reported. But what I like to look at here, take a look at this year over year headline. The top things that have increased, this is through June. We don't have July's numbers yet. Those don't come out till August. Fuel, oil, motor fuel, utility prices, specifically gas services, those are like significant outliers. That's a good thing. Those are volatile pieces, and it's not a good thing that we're paying more of the pump, but it's good to know that everything else is falling into a much better bell curve here. And as these pieces start to be alleviated or do whatever they do, we should see things start to calm down. Looking at core CPI, the big indicators here, the new and used vehicles, right here. Right now, they're accounting for about 17.5% of core inflation increases. This is much better than 6 months ago. 6 months ago, they were taking up like 30 and 40% of the overall inflation increases. We still do have some significant concerns. So things like shelter, specifically rent, we're seeing that those are increasing with their percent of inflation. Shelter alone is taking up almost 40% of the overall inflation costs. As those prices continue to fall, that's what's going to help to pull CPI down a little bit. So there's kind of where we stand. I know that was rapid fire, but man, we're already 15 minutes into it. So let's talk about where we're going. We have, this is interesting. We should have 5 questions to consider right now instead of 1, 1, 1, 1, and 2. But here we are. So these are the questions. Have we bought our I-bonds yet? We have made a huge push for our clients to open up those I-bond accounts, $10,000 per individual per calendar year. You buy them direct through treasurydirect.gov. You have to use non-qualified dollars to buy them. Have we funded our Roths yet? $6,000 if you're under the age of 50, $7,000 if you're over the age of 50, you must be working. I also kind of want to say here, have we max funded our 401ks? Have we max funded our 403bs? Have we max funded our SEP accounts? Have we max funded our simple accounts? All of those pieces are things that we should be looking at now. And it's a good time to start working the rest of the year's budget out to make sure that we max out those deposits. Have we looked at Roth conversions? Anyone who knows me knows that I'm crazy about Roth conversions. I think that this is something we should be looking at very, very aggressively right now. The reason right now is because prices are relatively low. A lot of people are seeing losses on their IRAs. Might be a good time to make a conversion over to a Roth, pay the taxes on that Roth, and then let all the recovery happen on a tax-free basis. So that might be something that we look at. There is no age limit, there's no income limit, there's no requirement to be working for Roth conversions, so anyone can do them. Have we looked at loss harvesting? Tax loss harvesting can be a very effective strategy to reduce your overall tax bill. This is specific to non-qualified accounts. Non-qualified accounts being non-IRA, non-Roth accounts. So if we have some brokerage money that's sitting out there, we should be looking at tax loss harvesting right now. We'll talk a little bit about that here in just a minute. And then finally, last, can I dollar cost average in this market? Dollar cost averaging is a very effective strategy that we can utilize to help reduce our overall risk, but still allow us to participate in market upside. So diving into this, great investments, I-bonds. If you're not familiar with these yet, you haven't been listening to all of our stuff, we think that they are very, very effective tools, and they will be for the near term. I don't think that these are going to be good long-term investments. I don't believe that we should hold these things for 10, 15, 20 years. But definitely while inflation is over 3 or 4 or 5%, this can be a very effective tool. In order to do this, you have to go to treasurydirect.gov. You've got to open up these accounts yourself. We have a fantastic YouTube video that walks you through step by step what you need to do. So if you're looking for that YouTube video, check out Oxford Wealth Advisors on YouTube. You can find that video there about how to open an I-bond. I walk you through step by step, and quite frankly, I'm showing you my own account. I opened up that account live right there and recorded the whole dang thing. So you can go through and check that out for yourself. The current rate, 9.62% through October. So that is a guaranteed rate. If you signed up now, that is the rate that you get until the next round of I-bond interest rates are announced. We're expecting that probably sometime in the end of September to see what those numbers look like. They are illiquid for 1 year. So if you park money there, you've got to leave it there for 12 months. There is an interest penalty if you take money out within the first 5 years. So they're not perfect, but man, finding 9.62% in this environment is pretty darn impressive. That's going to be something that we will recommend every day of the week. If you have any questions about that, feel free to reach out as well, but check out that video on our YouTube page. Give us a like and a subscribe so that you don't miss out on any content that we send out. Now let's talk about other things that we can do. So contributions, Roth contributions in particular, you can contribute up to 100% of your income up to the max of $6,000 if you're under the age of 50, $7,000 for those who are 50 plus. So with this in mind, this can be a very good time to start making those contributions. If we have earned income, if we're able to make those contributions into those Roths, now would be a good time to start putting money into those positions. Because the markets are down, it's a good time to buy. All the growth is tax-free. We can take advantage of that recovery without any tax concerns. You have to have earned income, and there are income limits that apply. So it's not a perfect scenario, but all things considered, it's definitely something we should be looking at. Now, I also just wanted to throw out here, I should have made a bigger point of this as well. Your contribution limits for Roth accounts, $7,000, like I mentioned. If you have a 401k or a Roth 401k, your contribution limits are $20,500. If you're over the age of 50, that goes up to $27,000 that you can put in. Now's a good time to sit down and look to see what have I already contributed and how much more do I need to be putting in through the end of the year to make sure that I max out that contribution. SEP contributions right now are $61,000. Technically 25% of your self-employed income up to a max limit of $61,000. Simple accounts, simple IRAs, contribution limit, oops, spell that right. Contribution limit is $14,000 with another $3,000 catch up if you're over the age of 50 for a total of $17,000. So now's a good time to sit down, look at where we are, and make sure that we're maxing out those contributions as much as we possibly can. If you have any questions about that, also feel free to reach out to us. We'd be happy to go through and discuss those different options with you. Okay, conversions. Let's start thinking conversions. Now, this is interesting because usually we'll suggest that you hold off on conversions until the end of the year, just because we don't know what our tax situation is going to look like. But because the markets are so volatile right now, it can be a very good time to maybe do a portion of a Roth conversion now, do the rest of it later. So we should be having a discussion to see whether or not that makes sense. The big push with this, there is no limit on your conversion. I'm painting a very rosy picture here. There's no limit, but you have to pay tax on whatever you convert. So I guess there's no limit on the taxes you can pay, but there's a point where it makes sense, a point where we want to be paying attention. There is no age limit, so literally anybody can do this. There's no requirement to be working, so everyone can participate in these Roth conversions. We should be having a discussion to see if that makes sense for your situation, for what you're doing. I mentioned here there are two strategies that we could look at: a bracket top up or a deadline strategy. Some of you may be aware of what these kinds of strategies are, but I wanted to take a second just to illustrate what those look like. Now, a bracket top up strategy, forgive the green, I didn't want to use red, so I chose a color that, I don't know, it's a little annoying. A bracket top up will require you to look at your tax return and see what bracket you're in. So just for quick and dirty purposes here, if I file married filing jointly and I make $100,000 a year, that puts me in the 22% bracket. A bracket top-up strategy will say, okay, the top end of the 22% bracket is sitting at $178,000. If I subtract out my $100,000 of expected income, that means I have $78,000 to play with in that bracket. Maybe this is the amount that I look at in terms of a conversion. Keeps me in the same bracket. I'm not jumping into any higher tax bracket. I'm maximizing that bracket as much as I possibly can. The second thing that we want to look at when it comes to these different strategies is maybe what's called a deadline strategy. I was talking to a client 2 days ago who said, hey, I've got money in these IRA accounts and I'm going to turn 72 in the next 5 years. And I would really like to do whatever I can to get everything converted before I have to start taking those required minimum distributions. So in this case, we did a deadline strategy. We take however much money we have in our retirement accounts, we divide it by however many years we're shooting to hit that deadline, and that tells us how much we need to be converting. Now, these strategies are ones that you can employ to maximize your Roth conversions. And we think that these two strategies are probably the most effective. They give us a plan and we know kind of what to expect. Now, every year we need to address to make sure that our bracket top-up strategy makes sense or that our deadline hasn't changed. But ultimately, we still need a plan to know how we should move forward with this. Let's kind of on that same vein, in terms of taxes, let's talk about tax loss harvesting. So again, this is specific for non-qualified accounts, non-IRA, non-Roth. If we just have some after-tax money that's sitting in a brokerage account, it's invested in stocks or whatever, if we've seen losses in those accounts, we can sell out of those positions, realize the loss, and use that for taxes. Now, for a lot of individuals, they say, oh, I don't want to sell because you don't realize a loss until you sell. That's true, but this can be a very effective way to pair off your gains and your losses. If you've got accounts that you purchased a long time ago, we've got folks that have bought Apple that have very, very low basis, that they paid next to nothing for Apple, and it's just grown immensely in the last 5 or 10 years. We can use this time right now and sell off some of the losers, pair off those losses with gains, and come out with a net tax-free benefit. Also, one thing to consider is everyone can claim $3,000 of loss carried forward every year. So maybe we should be looking at some kind of $3,000 loss, at least to take some deduction. I know that this is kind of a weird discussion because, we don't want to be down at all in our accounts. We never want to be down, but the real side of this is we're going to see that. We're going to see losses from time to time, and we should really make hay while that sun is shining. We think that this is a very effective strategy. So if you have these types of accounts, let's start looking at them specifically to see what kind of tax loss harvesting we can be doing through the end of the year. The reason we're having this discussion in July, and again, not before the end of the year, is if the markets continue on the same trend that they have been, I don't know when the bottoms of the markets are going to be. We never know when that's going to happen. So it might make sense to realize those losses now while we have them and take advantage of the tax benefit that those give here too. So, okay, Last strategy we have, we just released an OWA Live on dollar cost averaging. So this is kind of a fun strategy. We've actually been employing this with quite a few of our clients in the last 6 to 12 months. Maybe we say, hey, we've got some money, but we're not super comfortable about how the markets are performing right now. I'm not super confident that we're out of the woods yet. Gage keeps saying the yield curve is inverted, and I don't think that things are going to get better until the yield curve gets back to a normal level. Well, great. Dollar cost averaging is a strategy that we can utilize that will help to smooth out overall risk. Nobody can successfully time the markets. That's the tricky part. We look at all the data, we have no clue what tomorrow will bring. We try to make educated guesses, but ultimately that's what they are. They're just guesses. So dollar cost averaging takes the guesswork out. We buy equal installments during a specific period of time. And as we purchase, if the price of this thing is falling, we're buying at a lower and lower and lower price. Eventually things will start to recover. We'll hope once things start to recover, we make the last contribution, we dump everything in at that point. But rather than sitting up here at the peak and watching our accounts crater right at the beginning, we take kind of a slower approach and reduce our overall risk. Now, dollar cost averaging is one of the most common strategies with 401ks and other employer-sponsored accounts. I mean, kind of obviously, all of us may not even realize that we're doing it a lot of the times, but we make those contributions every 2 weeks or a couple times a month, whatever it is. We make those equal payment installments, whether we realize it or not. And those equal payment installments are going to buy whatever we're holding within our 401k. I guess what I'm trying to say here is realize that you can also do this with IRAs, Roths, and non-qualified accounts. So if you're wanting to get into something, this might be a good opportunity for you to maybe reduce some of the market risk, reduce some of the market volatility, and buy those equal installments over a period of time. Now, like I mentioned, we have an OWA Live from this week that we just barely released. Most of you on the call should be getting an email or should have received an email with that video attached. If you have questions about dollar cost averaging and how that kind of works, we would suggest watching that video first and then reach out to our office to see if there's anything that we can do to dollar cost average into a specific market. But we think that this is a very good strategy to look at moving forward. Okay, there we are. Feel free to give us a call, set up a time that we can go through and discuss these things. If there are any specific pieces that we want to make sure that we address, we want to make sure that we're sitting down with anyone who's looking for this information. We can go through and provide specifics as to how that applies to your portfolio. Check us out on YouTube. We've got a lot of good content out there. We are putting new videos out every Friday. So we've got our short 5 or 10 minute videos that go through a financial topic. Be sure to subscribe to our channel. That way you don't miss out on any of the videos that we have. And with that in mind, we'll see you next month for the next market update last Friday, the month of August. Thank you for joining us today. We appreciate you here. I see Lynn has put a couple of additional pieces when it comes to Roth conversions and things like that. Everyone's situation is a little bit different, so make sure that you're working with a financial advisor and a CPA as you're doing these things, but start having the conversation. That's really the key. Thanks for joining us. We will see you next month, and reach out to us if you have any additional questions or concerns on any of this stuff. Thanks, everybody.